And with inflation fears starting to subside a bit, my next guest says that should support stocks and keep rates from rising. He says the 10-year Treasury yield could even dip to 1.2%. Joining me now is Jim Caron. He's the global fixed income portfolio manager at Morgan Stanley Investment Management. Jim, welcome.
Thank you, Kelly. Thanks for having me on the show.
What do you think is the most out of consensus part of your call here? Because, is it the fact that rates could go to 1.2%, or we've seen so much of this already priced in lately with the 10-year dropping below 1.5? I'm just curious where kind of the next leg of the pain trade is right now.
Yeah, so I think of it in terms of positioning. I think that most people have been set up and most forecasters are calling for higher yields. I'm not going to argue whether yields are going to go up or down. What I am going to say, though, is that it's a non-insignificant chance that 10-year Treasury yields could get back down towards that 1.2% level. This doesn't necessarily mean that yields won't continue to move higher over the longer term or anything like that. But what it does suggest is that a lot of the inflation risk premia is starting to get taken out of the market at this point. What we have to understand is that in the second quarter, we can think of the second quarter as three peaks. We have peak growth, peak inflation, and peak policy stimulus, whether that's monetary or fiscal. We've gotten all this information at this point in time. What's the next catalyst then that could drive interest rates higher? If you've already gotten very big inflation prints, we already have the idea that tapering is probably going to start to get announced and come along at some point in time. They're already talking about it. So what's the next catalyst that could drive rates a lot higher? In the absence of that catalyst, I could see interest rates drift a little bit lower, or at least stay within this range for a longer period of time.
Let me ask the question a little bit differently. Why would people want to own a Treasury that, at 1.2% when you could, Goldman's forecast, which I think is sort of less, it's more dovish than a lot of commentators today would kind of make you believe. So Goldman says core PCE is going to be 3% by the end of this year, 2% by the end of the next year. Okay, fine, but why does someone want to own a 10-year Treasury at 1.2% in that environment? Does that not imply that the average inflation much further out is going to be dramatically lower than that? And what if that's wrong? Is that where you get higher rates?
Yeah, I think at 1.2%, I'd be harder to own that at that point. But at these levels around 1.5%, I think it's a little bit easier. Now, look, we're talking about a relatively small move here. But what we're also thinking about is a diversified portfolio and positioning. The thrust higher in interest rates took place really in the first quarter into the second quarter of this year. Since then, we've been moving sideways and we've even been drifting a bit lower. So if you think about it from owning fixed income to ballast your portfolio, your riskier asset portfolio that might include equities, for example, then I would argue that fixed income probably still has some opportunity to give you some yield and some potential return, particularly if things go wrong. Like what if, for example, we do start to get this decline in inflation? What if the Fed becomes, a little bit less patient and curves start to flatten down? The back end is going to be the beneficiary of a lot of that as a lot of the inflation risk premium starts to leave the market. So I think that's one of the reasons why back end rates can look a little bit attractive at these levels. I'm not saying that that's true for the next 2 or 3 years.
Right.
What I'm saying is that over the next couple of months, this might not be a bad place to be.
Shepard Smith here. Thanks for watching CNBC on YouTube.